Alright, so this is the lecture where I get to destroy your dreams. I think it's pretty obvious and also pretty understandable that most people who encounter machine learning for the first time think they're going to use it to forecast stock prices. I mean, this is the dream when it comes to finance. But after the previous section, you know that there's a lot to finance that you probably didn't even think was relevant. If I were to ask you, what do you think goes into a financial engineering course? This section on time series analysis would probably be the main focus. You'd think, well, obviously we start with time series analysis, going from simple linear models to deep neural networks, and we're going to show that as we add model complexity, the accuracy of our predictions will get better and better. And furthermore, you'd think that this is all you need to know to do well in finance. If you could predict the future, then nothing about the distributions of returns even matters. You just pick the stock with the highest predicted future return, and you're done. There's no need to discuss covariance, correlation, kurtosis, or t-distributions. That is the beginner dream, and in this lecture, I hope to wake you up from this dream. This lecture is all about the efficient market hypothesis, or the EMH. In a single sentence, the efficient market hypothesis says that you can't beat the market. The reason you can't beat the market is because stock prices in the market always reflect all currently available information. Because of this, stocks always trade at their fair value, and there is no opportunity to purchase stocks which are undervalued or sell stocks which are overvalued. The implications of this are that you cannot outperform the market and you cannot time the market. That is, you might try to buy now because you think the stock is low, or maybe you sell tomorrow because you think the stock is going to peak tomorrow. The efficient market hypothesis says that you cannot do this consistently. Sure, you might get lucky once in a while and you might think, aha, the EMH is wrong, I just made a 20% return. But the key is you must be able to do so consistently. The EMH says that you can't. So that's just the summary, but let's dig deeper into the details of the efficient market hypothesis. Firstly, the efficient market hypothesis makes some assumptions. I think these are a pretty reasonable starting point. We assume that there exists a large number of investors who are all interested in making money in the stock market. They obtain and integrate information rapidly as it becomes available. This makes sense. All major financial companies have very high-tech equipment, and they are on the bleeding edge of machine learning, big data processing, and so forth. Once these investors integrate new information, they will make trades such that the price of any stock will always reflect that new information. Again, these seem to be pretty reasonable assumptions. Now, we've been talking about information pretty abstractly. What is this so-called information that investors are acting on? In fact, this is pretty broad, which is actually why investing is such a large-scale engineering problem. We've discussed this partially in the previous section. Earlier, we looked at technical data, that's price and volume information. We also know that there's fundamentals data, such as a company's quarterly reports. In addition to these two, there's also exogenous data. This is a very broad term, and it could mean any public data that doesn't fit into the first two categories. For example, you could look at Twitter feeds or at the prices of other stocks. You might also look at the news. As an example of that, if something happens in China, that might affect Apple's stock price, since Apple's factories are in China. Finally, we have insider information, and this information is not public. This might be something like you're on the self-driving team and you just achieved a level of AI that allows for fully autonomous driving. In the self-driving industry, we refer to this as level 5. So if you know your team has achieved level 5 self-driving ability, you might want to go and purchase a bunch of your company's stock before they start selling their latest cars. Under certain circumstances, the use of insider information might be illegal. From these kinds of information, we can now discuss the three forms of the efficient market hypothesis. These are the weak form, the semi-strong form, and the strong form. Alright, so what do these mean? The weak form of the EMH is this. It says that future prices cannot be predicted using historical prices. Another way of stating this is that future performance has no relationship with past performance. Yet another way of stating this is that using technical analysis to predict future returns is not possible. Well, if this is true, then it definitely throws a wrench into our plans for this section, since it basically means you're not going to use these methods to predict the future. However, this is weak because it doesn't say other kinds of data, such as fundamentals data, is not predictive. The semi-strong form of the EMH is this. It says that stock prices instantly adjust to all forms of public information. That is, even if you have all the technical data and all the fundamentals data in the world, you still cannot beat the market. So if technical analysis won't give us an advantage and fundamental analysis also won't give us an advantage, then all that's left is private insider information. The strong form of the efficient market hypothesis is that even with all public and private data, you still cannot gain an advantage over the market. In other words, stock prices already incorporate all public and private data. Now at this point, the obvious question is, are any of the forms of the efficient market hypothesis actually correct? Let's note that the strong form of the EMH is the least likely to be correct. In fact, that's probably why insider trading is illegal. In fact, we have seen examples of people who used insider information to make large trades. As you go from strong to semi-strong to weak, these forms of the EMH become more and more likely to be correct since they each use less and less data. It's helpful to start by taking an outsider's view of this question. That is, don't concern yourself with the details of finance at all, but just look at how the topic is discussed. Usually when people talk about the efficient market hypothesis, they talk about it in terms of beliefs. They say, I believe this is true, or they say, researchers dispute. If this were a settled issue, people wouldn't use words like believe and they wouldn't have anything to dispute. They would simply say it's true or not true. Furthermore, recognize that this is a concept that people still dispute and discuss. If this were a settled issue, there would be no further discussion. What this should tell you is that even if the efficient market hypothesis is not true, there is some amount of truth to it. What it should tell you is that stock prices and stock returns are not easily and not obviously predictable. If all you had to do was plug in your data into an LSTM and call it a day, then these discussions wouldn't exist. But these discussions do exist because predicting the future is hard. Even if the market isn't perfectly efficient, it's at least pretty good at seeming that way a lot of the time. Going back to finance, what researchers do is they use statistical testing to check whether the different forms of the EMH are true. This goes back to the kind of hypothesis testing we discussed in the previous section. These kinds of tests are outside the scope of this course, but the idea of testing in general should give you some idea. What you want to do is devise a test and calculate some test statistic. If the efficient market hypothesis is not true, then this test statistic should be very improbable, and you would reject the efficient market hypothesis if that's your null hypothesis. Note that such tests have been done in the past, which do reject certain aspects of the efficient market hypothesis. Also consider the fact that there are some very famous examples of those who seemingly defy the efficient market hypothesis. Warren Buffett is one such example, and he himself disputes the efficient market hypothesis. Behavioral economists are an entire field of people who don't believe in the efficient market hypothesis. They believe there is a human element, and so actors in the market are not perfectly rational. So these seem like pretty plausible reasons why the efficient market hypothesis might not be true. It's important to note that the efficient market hypothesis does not say that nobody will ever outperform the market. Remember that randomness is inherent in stock prices. Stock returns are random variables. And so just as it's possible to have outliers who win big, it's also possible to have outliers that lose big. You just never hear about them. But these are simply seen as people who are lucky or unlucky. In effect, it turns stock trading into gambling. So ultimately, why are we discussing the efficient market hypothesis in a section about time series analysis? Well, if you're from a machine learning background, You're probably used to plugging in your data into a classifier and getting an accuracy of about 90 or 99%. If that's what you're expecting to see in finance, you will be very surprised. In finance, these techniques are not so much about making a perfect prediction of the future, but rather, if possible, making a prediction that's at least a little better than random. And failing that, it's not about prediction at all, but rather about modeling. If you're from a machine learning background, you're probably very accustomed to caring only about predictive accuracy. However, the modeling aspect is often forgotten. Modeling is important, not just for making predictions, but for telling you what you know and don't know. It can tell you what's possible to know and what's impossible to know. If you know that you can't know something, then you won't waste your time trying to predict it, and you will understand why. So this is a much more in-depth and nuanced view of machine learning. In fact, very shortly, we'll be looking at another hypothesis called the random walk hypothesis. The random walk is a model where you actually can't predict the future return of a stock, and you can only discuss its statistical properties.